There's a Chinese proverb that says, "Happy is the man with no sickness. Rich is a man with no debts." And on a basic level, this is true. Debt, as most people know it, creates financial struggles, since borrowing money is essentially taking money away from your future self. But now, we live in a world where debt is everywhere and is a major part of our economy. Virtually everyone uses debt. The difference is that some will use it to their benefit while others will misuse it. For many, the concept that debt can be good can be hard to grasp because most of us only know one kind of debt, or what many people call bad debt. These are debts that come out of your pocket with high interest, like credit card debts, car loans, student loans that will take years or even decades to pay off. In order to understand the positive side of debt, let's understand how people use debt to build wealth versus how the average person uses debt. Most people see debt as a way to buy something they cannot afford to pay in cash, like a car or a house, and they will spend years or decades paying this debt to finally own what they bought. For wealthy people, debt is just a tool that allows them to build something they can't by themselves or help them accomplish things faster. To the wealthy, debt simply means more resources to grow and accomplish more. One way people use debt to make money is to use it to expand or speed up their business growth. Some companies use debt to invest in the expansion of their business, like hiring new employees or opening more locations. Companies can also create debt with other businesses to get their products or supplies on credit if they don't have the resources to purchase them yet, or choose to keep their money for other reasons. For example, Steve Jobs made his first big sale for Apple using debt. He managed to sell 50 Apple I computers to a local computer store called the Byte Shop. But there was a problem. He didn't have the parts he needed to make those computers, and he didn't have the money to buy them either. So he went to a company that made computer parts and asked if he could get those parts on credit so he could build the computers. Since he had no credibility, he had to show the purchase order from the store in order to be able to get those parts on credit, which he did and completed the order, making Apple their first $25,000 in the 1970s, which in today's money would be around $115,000. Of course, if debt is used incorrectly, it can be detrimental to our finances. It is never recommended to use debt to start a business, especially if you are inexperienced. Many wealthy people spend time and resources understanding debt and how to use it. The second way many wealthy people use debt to make money is by adding leverage to their portfolios. You see, most investors take their hard-earned money and put it into an investment portfolio to grow over time. But some take advantage of leverage, which basically means using debt in their investment portfolios to boost their earnings. For example, let's say that our friend Tom manages to invest $100,000 into an investment portfolio that produces a 10% yearly return. This means Tom will make a $10,000 return on investment. His friend Jerry also invests $100,000 in the same portfolio, but he adds a 35% leverage to his account. This means he has a total of $135,000 in his portfolio, $100,000 of his own money, and $35,000 of debt. With a market return of 10%, Jerry makes $13,500 instead of the $10,000 that Tom made. So Jerry's return on investment goes up to 13.5% instead of the normal 10%. This method, although able to produce higher returns, comes with higher risks. Let's say that the market, instead of increasing 10%, goes down 10%. In this case, Tom will lose $10,000, but Jerry will lose over $13,000, since Jerry's portfolio is technically bigger than Tom's. Although it increases risk, leverage is widely used by sophisticated investors and hedge funds to increase long-term profits. But there are other ways investors use debt to make money even if markets are going down. There's a strategy that investors can use called shorting. With this strategy, institutions or individual investors don't borrow money, but instead borrow stock from a brokerage firm. For example, let's say that an investor predicts that company X will go down in value, so he borrows their stock worth $100. He now has debt, not for $100, but for one share of company X. This investor immediately turns around and sells this share in the open market for $100. He now has $100 cash. And lucky for him, it turns out his predictions were right. Company X had a big scandal for having mice in their kitchen, and stocks fell 85% in a matter of days. This means shares are now worth $15. Well, our investor takes $15 from the $100 he got from selling the share in the first place and buys back the stock at a huge discount. He returns the stock he owes to the broker and keeps the $85 as profit, minus a little interest for borrowing the stock. This is how many investors and institutions like hedge funds make money on a falling market. Now, this method is extremely risky. You see, when you invest $100 in the stock market, the most you can lose is $100. And that is if the company you invested in goes to zero. But when you short a stock, your losses can be theoretically infinite, since there's no limit on how high a stock can go. Take the recent GameStop debacle. Hedge funds shorted the stock heavily because it seemed like the company was going bankrupt. But retail investors didn't take that too kindly and bought so much stock that they bumped up the price of the stock to astronomical levels. Within a year, the stock grew over 11,000% from its low point, making hedge funds who shorted the stock lose over $13 billion. Now, there are other more traditional ways people use debt to make money. Real estate is one of the most common ways the average person uses debt to grow their wealth. Real estate allows an investor to buy property even if they don't have the money in hand to actually purchase it. This allows the investor to own a property and use it as a cash flowing asset. By borrowing money, they're able to leverage a bigger asset. They can have other people pay their debt, build equity for them, and create positive cash flow. Now, for those savvy investors, they can use a few other strategies to expand their wealth. For example, let's say that we buy this property for $300,000. We put $40,000 as a down payment and finance $260,000. This property isn't the nicest, but it's in a great location, and the local market is booming. So we decide to spend an extra $10,000 to fix it up and make it look nice. Since this house is in a great location and the market is going up, we decided to get our property reassessed, and it is now worth $360,000. With this new figure, we can go to our bank and refinance the property. We can add this additional $60,000 to our property's equity or cash it out, essentially borrowing from our own assets to invest in another property that can make us more money and expand our wealth. When it comes to using debt to make money, sometimes it can be better to finance things that we want to buy. When interest rates are low, it can actually make sense to borrow money. If you are going to buy a car for $50,000, for example, and you can borrow that money at a 2% interest rate, it can make more sense to finance the car instead of paying for it with cash. If you invest those $50,000 into the stock market and it gives you a return of 10% per year, you will be making more money back from your investments than you pay in interest. For example, if you get a 5-year loan for your car at a 2% interest rate, you will end up paying a total of $52,583 including interest. But in those 5 years, if you invested those $50,000 into the stock market, it would have grown to $80,525, a profit of almost $28,000 made with the help of debt. Now, one of the biggest ways wealthy people use debt is to avoid taxes. Wealthy people are quite astute when it comes to avoiding taxes. Normally, when you invest your money for retirement, you let your assets grow in value, and once you have enough money to retire, you begin slowly selling your assets or using your assets' cash flow to pay for your lifestyle. But this also means that you will have to pay taxes on this money. If you buy stocks or real estate properties and begin selling them when you retire, you will have to pay capital gains tax. Let's say that you worked very hard and now you have a $30 million real estate portfolio. You feel like you are ready to relax, retire, and enjoy the fruits of your labor. So you sell a property for a $10 million profit to pay for your retirement. The sale of this property will trigger a $2.3 million capital gains tax to the federal government. Then, since you live in the state of California, you will pay an additional $1.3 million in state taxes, meaning you will pay a total of $3,754,365 in capital gains tax. So your $10 million profit is now $6.2 million. Nearly 40% of your profits went to taxes. As an investor, losing 40% to taxes doesn't sound like a great plan. So instead of selling the property, you decide to borrow those $10 million and use your $30 million real estate portfolio as collateral. Since debt is not income, it cannot be taxed. So you can enjoy your millions without having to pay capital gains tax. Now, since you borrowed money, you have to pay it back. This is when wealthy people use another tax loophole called the step-up basis to completely eliminate the need to pay taxes. Normally, when you buy an asset that grows in value, you have to pay capital gains tax on the profits you made. But when you use a step-up basis and pass your assets to your kids, the asset's starting value is adjusted to the current market value. For example, if you bought a property for $100,000 and it is now worth $400,000, you had a $300,000 gain, and you would pay taxes on that gain if you sold your asset. But when you pass your asset to your kid using the step-up basis, their starting value is $400,000. If they sell the property at that price, they will pay no taxes because there was no growth in value under their ownership. Technically, they didn't make a profit. This strategy is called buy, borrow, and die. Because to avoid paying taxes, you use your money to buy an asset, you then borrow against that asset to finance your lifestyle, and at the time of your death, you pass down your assets to your kids using the step-up basis, then they can sell the assets with no tax consequences to pay off the debt. The benefit of this strategy, other than avoiding taxes, is that since you did not sell your assets to pay for your lifestyle, the assets continue to grow in value. So you end up with more money by borrowing rather than selling your assets. As you can see, debt isn't always bad if correctly used. Of course, it can be detrimental to our finances if used incorrectly. An interesting book that touches on the topic of managing and leveraging debt is Robert Kiyosaki's Rich Dad's Guide to Becoming Rich. And you can listen to the audiobook with the sponsor of this video, Blinkist. You see, Blinkist takes the top non-fiction bestsellers and puts them into 15-minute text or audio explainers, so you can listen to the main ideas of a book podcast style. You can learn about topics like philosophy, history, and science, or dive into psychology, health, nutrition, personal growth, or one of my favorites, finances. You have thousands of the best titles in 27 different categories to choose from. And now they have a new feature called Shorecast, where you can get the main ideas of a podcast much faster. One of my favorite features of Blinkist is that I can download and listen offline. I personally love to travel, and being able to cover a couple of books while I'm traveling makes that time that I don't really do anything actually beneficial. Especially when I want to dive deep into a book, because with Blinkist you can download full-length audiobooks at a massive discount, up to 65% their retail value, which basically pays for itself. But right now, the first 100 people to click in the first link in the description of this video will get an entire week of premium access to Blinkist absolutely free. So join the 14 million users already using Blinkist and expand your knowledge with Blinkist. And as always, thank you for watching, and I will see you in the next video.